Hello participants, how are you? Welcome to the day 3 of ACCA Practice to Pass sessions for March 2021 attempt. I am Kait Johar, your facilitator for financial management. Assalamu alaikum. Let's start today's class. In the last session, yesterday night, we were left with some cost of capital questions and some important areas of cost of capital which are yet to be covered. So first we'll be covering the cost of capital areas today, and then we will move on to the business valuation area. So in the last session yesterday night, I was discussing that the cost of equity is higher than the cost of debt. Now why is it so? Why is equity expensive compared to the cost of debt? The main reason is the risk which the investor has to take. And I told you that the risk means the variations in the profits that occur in a business. So whoever does a business, he will be facing a risk. He'll be facing a risk of fluctuation in sales. And if the sales fluctuate, the profit also fluctuate. So when the investor invests in the form of equity, he will have to face the effect of this risk, which is known as a business risk. And we also talked about the systematic risk, as unsystematic risk gets diversified and the investor asks for only the compensation of the systematic risk. But in case of investing in a loan note or a debt instrument, the investor is not exposed to the profits, because even if the profits change or are different, the company, the borrower, has to pay the same amount of interest, so he's not exposed to the profitability of the company. So that's why the debt instrument, investment in debt instrument, is cheaper. Okay, so in the last class we started discussing the CAPM model, the cost of asset pricing model. So let's uh, start with the capital asset pricing model. On the screen you can see in the red bar the formula for the capital asset pricing model. So let me tell you about the inputs in it. So there are 3 inputs. You have to plug in 3 figures in order to arrive at the cost of equity. And those 3 inputs are: K stands for cost of equity, RF stands for risk-free rate of return. Usually, government bonds are safe to invest. And if you lend money to government is interest free, government is risk free and will pay you smooth interest. And the principal as well is risk free, as the government will not default, right? So it's a risk free investment. And the RF is return from the risk free investment. Then beta, and the third plug-in figure will be the return on market, the market return. Now return on market means return on the stock market, return from a well diversified portfolio of investment in ordinary shares which are risky. So this market return is basically a combination. The market return is return from a combination of investments made by a prudent shareholder into ordinary shares, into risky investments. So this is the return from the risky investments after diversifying the unsystematic risk, right? So these are the figures which you need to calculate. So in this question, Now, students, let's start with this question. Our today's first question is BKB company. So please read this question. BKB. We'll start doing this question. BKB in a few minutes. I'm giving you some time to read the question first, and then we will start. Okay, students, let's start with requirement A. Calculate the market value after tax, weighted average cost of capital. So we need to know the cost of capital. So what capital items are present over here? So in this question, we have ordinary shares. So from this source, the company has borrowed and obtained some money. It has also obtained from convertible bonds. It has also obtained some money from preference shares. So these are the three sources from where the company has obtained funds, and we have to calculate that what will be the cost of obtaining funds from these three sources, the average cost, the weighted average cost. So first of all, we need to know the cost of the ordinary shares, which is KE. Now in this question, look, they have not given you any information regarding the dividends, and the information they have given is regarding risk-free rate, market return, and beta. So in this question, they are expecting you that you will calculate the cost of equity using the capital asset pricing model. So let's calculate first the cost of equity, then we will calculate the cost of convertible bond, and then we'll calculate the cost of preference shares. So three costs we have to calculate, and three market values as well in order to know the weighted average cost of capital. So students, let's begin. I have marked a few items. The beta is 1.2 and 5% is the risk premium. Risk premium is the difference between the return on market investments and return on risk-free investments, and 4% is the risk-free investment. Okay, so let's start doing. Okay, so the risk-free rate is 4% plus 1.2 is the beta, and we'll multiply it by 5%. So this gives you the cost of equity, which is 10%. So this is the first step. We get the cost of equity. Now, our next move is cost of debt and cost of preference shares. So let's first calculate the cost of preference shares. KP, cost of preference shares. Now the same formula we used in the last night's class, that we'll be using to calculate the cost of preference shares. So what they are telling about the preference shares, they have given you the market value of the preference shares, which is 6.25 million, and the preference share is the 5% preference share. This 5% is the dividend, which is payable on this $1, the face value of the preference share. So 1 multiplied by 5%. This gives you the dividend. So the dividend makes up to 0.05, right? Okay. Now, how many preference shares are there? So the quantity of preference shares is 10 million and its market value is 6.25 million, which is given over here. So first you can calculate the market value of a preference share. So let's calculate the market price of one preference share first. So the market price of a preference share is 6.25 divided by 10. So this makes the market price is equal to 0.625, and the dividend is $1 multiplied by 5%. The face value into 5%. Dividend is always on the face value. So this makes 0.05. So let's calculate the KP. So KP is simply the dividend divided by the market price, as discussed in the last class, multiplied by 100. So we will usually we will assume that preference share is irredeemable. But suppose if they have given that it's a redeemable preference share, then you will have to calculate the IRR. But for that, you will have to know you need to know the life of the preference share. Okay, so over here 0.05 divided by 0.625 into 100. This gives you the cost of preference shares. Which is 8%. So 8% is the cost of preference shares, and now we'll move on to the cost of debt, the convertible bond. So next is the cost of the convertible bond. Cost for the CB. CB stands for convertible bond. You can write just KD, cost of debt. That's the next one. So the cost of convertible bond will be the IRR, internal rate of return. We have to calculate the internal rate of return for the convertible bond. Now let's check how to calculate the IRR. It's in the same way that we normally calculate the cost of debt, the cost of bond, like we did in the last class. What we'll do, we'll calculate two NPVs connected to the cost of bond, connected to the bond. So let's first calculate some basic requirements before we go on to calculating the net present value. So first we need to know the market price of a convertible bond. So the convertible bonds are right now being traded at 21 million. The market value is 21 million, and there are total, you can note, stated in the balance sheet are at 20 million, right? So there are 20 million convertible bonds. 20 million is the dollar value of the convertible bonds in the statement of financial position. So first we calculate the price of one bond. We will multiply 21 by 100 and divide by 20 million in order to know the number of the price of one bond. So it's 21 into 100 divided by 20 gives you the price of one convertible bond, which is 105. The face value of each convertible bond is 100 and the market price is 105. Now, market price of an ordinary share. Now, why I'm calculating these values, I'll let you know in a short while. So market price of an ordinary share is 125 million is the market value of all the shares, and there are in total, the capital is 25 million and each share is of $1. So 25 million are the number of shares which are present. So if you divide, you will get the market price of one ordinary share. So 125 divided by 25 gives you market price of one ordinary share, which is $5. Now, why I have calculated the market price of one ordinary share? The characteristic of a convertible bond is that if you invest in a convertible bond right now, when the life of the convertible bond gets over at the time of redemption, you are given an option. The investor is given an option to either obtain cash as repayment, or the investor can also obtain shares. Now, what will the investor do? Obviously, the investor will go for profit maximization and he will choose the option with the highest value. If cash is more, then he'll be going for cash, and if the market price of shares is more, then he'll be going for market price. So now, according to the question says that every year from now on, after buying the convertible bond at $105, so if one buys a convertible bond at 105 now, the market price of share, the $5 is the market price of a share, it will keep on increasing by 4% as per question. So you can see over here. Let me mark. Over here, the question says the current ordinary share price of BKB is expected to increase by 4%. And then after the life of the bond gets over, which is 5 years, this bond is of a 5-year duration, right? Which is mentioned over here, the 5-year duration. And then once the 5 years are over, the the bondholders are given an option to either receive cash as repayment or obtain 19 shares for each bond, against each bond. So they can either take cash or they can obtain 19 shares per bond. So in order to first know that whether investors will be interested after 5 years time in cash or they will be interested in shares, we need to first calculate the market value. So that's why let's calculate the market price of a share in 5 years time. So market price of an ordinary share in 5 years time. This is going to be 5 multiplied by 1.04 to the power 4. Why power 4? Because the prices will increase 4 years. Sorry, why power 5? Because the market price will increase every year for 5 years. So the market price is going to be 6.0 0.08 in 5 years time. And therefore, if the investor opts for conversion into ordinary shares, he will be getting 19 multiplied by 6.08, and this makes 115.52. And if he obtains cash redemption, so the cash redemption option which is available this is 100. So what should he do? What should he do? Whether he should obtain cash or he should go for conversion. So obviously the bondholder will opt for conversion. So according to this, now we will make the cash flow and we calculate the IRR, internal rate of return. And for IRR we need two NPVs. So the cash flows is first the investment amount, market value of bond now. This is the investment, and the market value now is 105. And against this, you will be receiving interest. So if the investor invests 105 now, he will be receiving an interest since year 1 till year 5. And what will be the interest? The interest amount is going to be, sorry, the interest amount is going to be 100 multiplied by the rate which is 7% on the bond, and there is a 30% tax. So after tax, he will be receiving 4.9 on each bond. So the working is 100 multiplied by 7% multiplied by 0.7. Okay. So this is the interest that he will be receiving, and that's in positive. So that's the cash inflow for the investor. And then at the time of redemption, the investor will be able to receive how much? The conversion value that we calculated above, which was 115.2, 115.52, sorry. So that's the cash flows involved in the bond. So first we will calculate the present value, and therefore the NPV using 7%. It's a basically 7% is the same rate as quoted on the bond. So I'm taking that as a sample, but you can take any rates. You can either start with 5%, 10%, you can take any rate. So in this case, the present value fractions are going to be take an annuity fraction for interest as it is going to occur for 5 years, and then the redemption at the time of redemption, the present value fraction will be 0.713 at 7%. The present value will be as follows: 4.9 into 4.1, this will become 20.09, and 115.52 into 0.713 will be 82.37. So there you get the first net present value. So minus 2.54. So as you get a NPV in negative, now we will try a lower rate, a present value fraction at suppose 6%. You may try at 5% as well. So present value fractions at 6% will be 1, annuity fraction will be 4.212, and 0.747 will be the present value fraction. And this gives you the present value. So the net present value is 1.93. Now apply the formula for the IRR. So internal rate of return, the lower rate 6% plus NPV at the lower rate 1.93 divided by NPV at the lower rate minus the NPV at the higher rate, which is 2.54. Minus minus will become plus, and then multiplied by the higher rate 7 minus the lower rate 6%. So this gives you the IRR, the cost of the bond. So the cost of the bond is 6.43%. So in case of convertible bond, you have to first check that whether the investor will go for a cash redemption or he will go for a conversion into shares. If he goes for conversion into shares, then at the time of redemption, you are going to use the redemption value, which is 115.52. So that's the value of the convertible bond now. So the cost of the convertible bond is 6.43%. So there we go. So we have got now the cost of all the three sources of finance. Now the next requirement is we will need to calculate the market value of these three items. So let's move on to the calculation of the market value of these three items. We know the market values. They have been given in the question. Okay, so let's take the market value of equity, then market value of preference shares, which is P, and the market value of convertible bonds. So according to the question, the market values are: the value of equity is 125, the value of preference shares is 6.25, and the value of the convertible bonds is 21 million. So this in all makes 152.25. Now we are in position to calculate a WACC, weighted average cost of capital. So the weighted average cost of capital is now, first take the cost of equity. So the cost of equity was 10% according to the CAPM, multiplied by 125 divided by 152.25, then plus the cost of preference shares, which is 8%, multiplied by the market value of preference shares 6.25 million divided by the total 152.25, and then the cost of convertible bond, which was 6.43%, multiplied by the market value of the bonds 21 divided by the total market value of all the three instruments 152.25. This gives you the WACC. So the WACC is calculated to be 9.4%. So 9.4 is the weighted average cost of capital in this situation. So in this question, we learned the cost of convertible bond, calculating the cost of convertible bond and cost of equity using the capital asset pricing model. Okay, so please you can note down if you want. I'm waiting for a minute for you to note down. Then I'll move to the next question. Okay, Sidra Aslam asked for what is beta actually. Beta is basically it is a risk of investing in a particular project or share, right? Compared to the return or the risk of the market portfolio. Suppose the risk of the market portfolio is 1, and the if you invest in a security, its market value is high, its risk is high, sorry. So if the risk of an individual security is higher than the market portfolio's return, which is a well diversified portfolio, in that case the beta will be greater than 1. And obviously if the investment is more risky, uh, the investor will ask for more compensation. So beta if more than 1, then the cost of equity will be higher than the market return. And if the beta is lower, means the project which you are uh, evaluating and you want to invest in it is less riskier than the market portfolio. So the beta will be less than 1, and the return which you will ask for in that case will be lower than the market return. Is it clear, Sidra? Okay, market value of the convertible bond is simple. Uh, See, what I did first is 20 million was the face value of the bonds, right? So first what I did, I divided the 20 million by the face value 100. So I got the number of bonds, and then I multiplied by 21 million. One of the one convertible bond should be uh, stated in the market at higher than its face value. Na? That's why the market value is higher. Huh. Actually, after tax weighted average cost of capital means after considering for the tax shield. So when we take interest over there and we take 70% of it, so means that we are taking tax WACC. Always you have to use the WACC which is after tax, right? So according to M&M theory, you have to take WACC after tax. You can't before tax, okay, I've discussed, I basically 1 million bonds, and I have a value of just one bond. Okay. Okay, there is a question. How did I calculate the conversion value? So see, Sophia, first what I did, I calculated the market price of an ordinary share after 5 years, right? So the market price of an ordinary share after 5 years was 6.08. So the market price of the share was right now 5, and it was increasing by 4% for 5 years. So I kept multiplying the $5 market price 5 times with 1.04 and arrive at a market price which becomes 6.08. And then the question says that when you redeem the bond and the bond is converted into ordinary shares by the investor, if he chooses for converting it into ordinary shares, so he asked for 19 bonds. So 19 multiplied by 6.02. This gives you the conversion value 115.52. Is it okay, Sophia? Okay, is my voice clear now? Students, can any one or two of you can uh, tell me regarding my voice? Is it clear now? Are you being able to listen to me properly now? Am I audible? Today's topic is cost of capital, and then we will be doing business valuation. Okay. Okay. So let's continue, students. With next requirement now. Okay. According to the feedback given by the students, uh, most of the students are being able to listen to me. A few of them are not. Okay. Okay. Maybe some internet problems going on there. So I think it will get better in a few minutes time. So please continue with at least the try to understand the workings which are doing on which I'm doing on the screen, uh, and then I hope that in a short while it gets better, right? Okay. So students, what's next? The question asks for, let's move on to the requirement B. The question is, requirement B is, discuss why market value weighted average cost of capital. Market value weighted average cost of capital is preferred to the book value weighted average cost of capital. Now, book value is the values of equity in the statement of financial position, and the market value is the value in the stock market. The share market, right? Now what happens that let me explain that okay, I'm explaining about the use of market value based market weighted cost of capital. One should always use the market value based WACC. Why? The question is why? The answer to this question is that the market value, okay, let me go a little bit more deeper in it. There are usually more than one source of finance, like debt, which is cheaper than equity, right? So what happens that the WACC considers that how much of the total financing is through equity and how much is from debt. If more is obtained from equity, then the WACC will be high, right? Because equity is expensive. Right? So now, if we use the book values, which do not change with time by much, the portion of equity in WACC calculation will be taken lower, and therefore the WACC will be lower than the actual, and will make NPV of many projects positive when in fact they are negative, and the decision making become wrong, right? So that's the reason behind why market value weighted average shall be taken. Yes, there was a MS Word sheet as well for today's lecture. Okay, so students, that was the answer to the requirement B. Now moving on to the next requirement. Students, the next question for our today's class. Okay, one of the student is asking about the market value of a bond. let me tell you again what I did to calculate the market value of a bond. Look, what to do? I'm explaining again. To calculate market value of one convertible bond, do it like this. Take 21 million first. 21 million is the market value given in the question. It's here, right? And then divided by the number of bonds. 21 should be divided by number of bonds. So how will you get the number of bonds? 20 is the value of bond in the balance sheet. Divide the 20 by 100, which is face value. Do like this and see what's the answer on your calculator. Check the answer. Now this fraction gives you number of bonds. And the question is not giving you price of one bond. The question is giving you price of, this is the market value of 0.2 million bonds. There are 0.2 million bonds. In total. So if you divide 21 by 0.2, you will arrive at 105, which is the price of one bond, right? So student, is it clear? Kamran, is it clear now? Okay. I hope many of you who were asking for this price are now clear. How did I do it? Okay, so let's move ahead to the next question. So students, our next question is card company. Let's start doing card company. Please go through the question first, students. I'm giving you around 2 to 3 minutes to read the question. Please read the question, then we'll start. Question, card company. I'm waiting for you to read the question first, then I will start. Okay, so students, let's start doing this question. First, we have to calculate the cost of equity of card company cost of equity of card company using the dividend growth model. So in order to use the dividend growth model, we first need to calculate the growth rate, the dividend growth rate. So for dividend growth rate, the latest dividend uh, for this year is this is the latest dividend, and 55.1 is the earliest dividend. So what we will do is 62 divide by 55.1 to the 0.3 or 1 by 3, because 3 years we are calculating this. Dividend has changed in 3 years time from 55.1 to 62, and then so this gives you the growth rate, which is equal to, multiply this by 100 in order to arrive at the growth rate, which is 4% or 0.04. So that's the growth rate, and then we'll put the growth rate in the cost of equity formula. So taking the dividend as 62 cents multiplied by 1.04, which is the growth rate, divided by the market price. So the current market price is 716 cents plus the growth rate, which is 0.04. So this gives you the cost of equity of card company using the dividend growth model, which is 13%. So that's our working. First for the growth rate and then for the cost of equity. See, there are 4 years, there is a 4-year time. It is taking like this. Shehzad, let me explain. I explained it yesterday as well, that we we are basically calculating that in how much time the dividend has changed from 55.1 to 62. So it is like this. Let me show you in blue color. You'll be able to see in blue color. See what happened. This is in first years, in 1 year time, that dividend got increased to 47.1, then 2 years, and then 3 years. It's an n-1 rule. So if you have 4 years, so there are in fact 4 years, but the dividend has changed in how many years? In 3 years. So you have to take the time in which the dividend has changed. So you have to use the n-1 rule. Clear? Shehzad, is it okay? Okay, let's move ahead now. See, if you are very comfortable with the formula and you know you are doing it correctly, you don't need to write the formula. Just go for the calculations, because examiner knows what you are doing, right? But if you are, suppose, not being able to plug in figures properly, and you feel a risk that you may get wrong, right? So write the formula so that you can get at least the marks for the formula, right? Most of the formulas are usually given in the exam as the formula sheet. So obviously you won't get marks for those formula at least, unless you plug in properly. Okay, let's move on to the next part now. Now what they say in part B, discuss whether the dividend growth model or the capital asset pricing model should be used to calculate the cost of equity. So the debate over here is that which model is superior to calculate the cost of equity, dividend growth model or CAPM. So it's CAPM. The CAPM model is superior to the dividend growth model due to the following reasons. And they are: one, the first reason is that the growth rate used in the dividend growth model is a historic growth rate, and it is assumed that it will continue in future as well, which is not an appropriate assumption. Secondly, there are market perfections, there are market imperfections that do not allow to find the accurate market prices to be plugged in the dividend growth model. So these are the two limitations of the dividend growth model, that you cannot find the accurate market price and the growth rate. And the third point, which is the strength of CAPM, that CAPM is based on a very strong theoretical concept involving a well diversified market portfolio. So these are the reasons behind why CAPM is preferred, right? Although you should write this fact as well, that even sometimes it gets difficult to find the plug-in figures for the capital asset pricing model as well. So CAPM may not as well work in a better way if you do not you are not able to get the plug-in figures for CAPM, right? But theoretically it is a sound one, although the CAPM may also sometimes do not give better results due to poor estimations of the plug-in figures. Like RF and RM or beta. So this is the discussion you would have written for the part B. Okay, students, now the next part is very important, very important part. The next one, by market imperfections, we mean that people are sometimes speculating in the stock market, due to which the prices of the shares increase, or sometimes there are brokerage costs as well which are affecting the share prices. So we just want the prices which are perfectly reflecting the market prices, right? The market conditions mean the profitability of the company and the future prospects, right? Okay, students, I'm really sorry for some I think there are some internet problems, but we have to bear it. because this is not in my control. I'm trying my best to do it in a better way, but please try to concentrate, remaining within the circumstances which are out of my control, right? Thank you, students. Thank you for cooperation. Okay, actually, the reason why I'm writing things also on the screen is that if you do miss some points uh, which I have discussed in voice and you have missed it, you can get it from the screen. So you can also look on the screen to see what I'm discussing, right? So that's a good idea. Okay, students, let's move on to the next part. Now, this is a very important part of this question, and that is calculating project specific cost of capital, project specific cost of equity for card company. So let's calculate the project specific cost of equity for the card company. Now, how will we calculate it? Let me show you. What do we mean by a project specific cost of capital? The beta for projects that we evaluate will not be same for different industries in which a project will operate. For example, a beta or beta which represents risks, systematic risk, will be different for a textile project compared to an automobile manufacturing project. Agreed? So when beta is different, then cost of equity will be different, and therefore, and on the base of cost of equity we calculate WACC. So if cost of equity will be different, and therefore WACC will also be different, right? So what is the important point? That you can same WACC cannot be used to calculate two projects that are in different business sectors. So in order to calculate different WACs, different betas, and therefore different cost of equities will have to be calculated, right? So as the betas will be different in different projects and different industries, cost of equity will be also different according to the CAPM rule, right? And the WACC will also be different. So we need to calculate a project specific WACC. Now, how will we calculate a project specific WACC? Now, moving on to that. So let's move on to a project specific WACC now. So let me show you the project specific WACC. How will we calculate it? Students, I will be sending you these worksheets by the end of this 5-day session. So you'll be able to get these discussions as well with you people afterwards. Okay. So now let's move on to calculate the project specific WACC. Project specific cost of equity. For project specific cost of equity, we need a proxy company. Suppose you are in a textile industry and you are starting a project in an automobile industry. So find a company in the automobile industry and get their beta. We will get their beta first. We need a proxy company beta. Which will be adjusted, which will be de-geared first. De-geared means that the effect of, as I said in the last class, that the beta involves the business risk and the financial risk both. So we just need the business risk of automobile industry, not the financial risk. So first we will adjust the effect of the financial risk. We will remove the financial risk of the company in the automobile industry, because our financial risk and their financial risk will be different, but our business risk will be going to be same, because we are investing in the same sector, the automobile sector. We too, and they are also operating in the automobile sector. Our project is now a new one in the automobile sector, right? So the financial risk will be different. So first we will remove the effect of the financial risk. So what we will do, that we will first remove the effect of financial risk of the proxy company. Okay, this can be done using a formula to de-gear, and this is the formula for it. Read in the yellow. Beta asset BA. BA is the beta asset and only represent the business risk, no financial risk. So the formula is beta equity of the proxy company multiplied by the equity of the proxy company divided by the equity of the proxy company plus debt multiplied by 1 minus tax of the proxy company. This is for D getting the beta of the proxy company. So we will do it, do this in this question. Let me show you the plugin figures for this from the question. So these are the plugin figures, which will be circled in blue color. See, the proxy company has an equity beta of 1.038, and it is financed 75% by equity and 25% by debt. So using this and the tax rate of 30%, I will first remove the effect of the financial gearing from this beta 1.038. Let's check. So calculating the beta asset. So beta asset is equal to 1.038 multiplied by 75 divided by 75, which is the value of equity, plus 25 is the debt proportion, 1 minus 0.3, which is the tax rate. Doing this will give me a beta of 0.841622. Now this is the D gate beta. This will always be lower than the original beta. Like the proxy beta, the proxy company's beta was 1.038, and after removing the financial risk, obviously the risk will reduce. So as the financial risk is removed, the only business risk is 0.84. It will always drop. And then in the next step, we will calculate the BE. BE is the beta equity. Now this will include the financial risk again, but now this time the financial risk will be taken of the company itself, the card company itself. So now we are using now we will calculate the beta equity of the card company itself. So in this case, look what I did first. First I used this formula to de-gear. So these equity and debt plugin figures were all belonging to the proxy company, all belong to the proxy company in the suppose automobile industry. And now we will be using the formula which I'll highlight in red. This formula will be used because obviously the card company is a gate company. It does have some borrowings. So now we will introduce and add the financial risk to the beta, which is 0.841622. So now we'll be calculating the beta equity of. So now the figures which will be plugging in will be all of the card company's figures. So putting in the card company's figures. Now, so let's put in the card company's figures. So the formula we are using now is BA, which is 0.841622 multiplied by, we have to use E. So E for card company. E for card company is the card company has issued 8 million ordinary shares. It has 8 million ordinary shares and price of a share is 716. So this gives you 8 multiplied by 716 cents, 5728 cents. This is the market value. So if we take it in dollars, $7.16. So let's make it in dollars. 8 million multiplied by $7.16 is the market value of card company's equity. And then we need to know the market value of the debt of card company. So the card company has bonds in the balance sheet which are of 5 million. We will divide 5 million bonds to 100 and then multiply it by the market price, which is 103.42. This is the market price. So by dividing 5 million with 100, we get the number of bonds and multiply it with the market price of one bond, which is 103.42, which makes 5.171. Right? So this is the value of equity and debt of card company. So we'll be using this in the formula. So let me plug in these figures in the formula. So now the formula is E, which is 57.28 plus D, which is 5.171 multiplied by 1 minus tax rate. And then divide this by the value of debt. The value of debt is 5. Divide this by the the value of this is value of equity, yeah? In the formula. So the value of equity is 57.28. So when you solve this, please solve this out and check what the beta become. So now the beta becomes 0.894805. It becomes 0.894805. So this is your beta equity. So the proxy company's beta was 1.038 and the beta to be used by card company for its own investment projects is 0.894805 using its own financial risk. So now calculate the cost of equity. We have got the beta. So calculating the cost of equity, the risk-free rate is 4% plus the beta, which is 0.894805 multiplied by the risk premium, which is 5%. So this gives you the cost of equity, which is 8.474. So this is your risk adjusted cost of equity, project specific cost of equity. So there we go. We get the project specific cost of equity. So you have to do two steps in order to calculate this. The first step is de-gearing the beta, the proxy company's beta. This is your first step. Okay, we did this step first. We de-gear means remove the gearing effect, the financial effect, and then re-gear it in the step 2. Step 2 means you have to now consider the risk of the financial risk of the card company itself. So in the second step we get the beta, and obviously remember this tip. These formulas are given in the exam, but it's better to learn that the ungated beta will be lower than 1.038. Remember always, and this will be plugged in the next formula. And the beta arising from this formula will always be higher, because due to the incorporation of the financial risk, the beta will increase. So in the first step, the beta will decrease. The proxy company beta will be higher, and the ungated beta will be lower. And the second step, the beta will increase due to the incorporation of the financial risk. Right? Okay. I hope it's understood. Okay. That's the risk premium, RM minus RF. Yeah, they will mention it. They will definitely tell you that you are investing in a different company, and by financial risk you will find it yourself, as they had given you in the question that 75 is to 25 was the ratio for the financial risk, right? And uh, the equity for card company as we calculated was different, right? So you can know yourself that the debt to equity ratio will be different. So they would have given you the debt and the equity ratio for the proxy company, and you will see the debt to equity ratio yourself for the company you are evaluating the project. Is it okay, Kamran? And Advait, did you get, how did I get the 5%? They have given the premium, the difference between the RM and the RF, to be used in the CAPM. Okay. Okay, students, let's move ahead. Uh, Samir, WhatsApp link has already been shared. My number has also been shared. You can contact me on my number. I'll give you the link. Whoever has not been added to the group can contact me directly. I'll invite you to join. Okay, it was shared by the administrator. You can get it. Okay, okay. I'll help you out afterwards. But please let me finish the class. Nah? Okay. So students, let's move on to the next question now. This is card companies over. The next question is ill colleague. Okay, students, please go to this question. Ill colleague. Please read this question out. Okay, students, I hope you have gone through the question. Uh, now, let's calculate the weighted average cost of capital using the dividend valuation model and the capital asset pricing model. So starting with okay, students, I'm taking a 1 minute break. After 1 minute break, you can read through the question once again. Okay, students, let's start doing this question. First, we will calculate the cost of equity using the dividend growth model. Cost of equity using the dividend growth model. Okay, so let me first calculate the dividends, dividend per share. So the dividend per share in this question is the dividend for the year was 2.14 million and the number of shares outstanding are 10 million shares. So this gives you the dividend per share, which is 0.214. So you can say it is 21.4 cents, the dividend. And then they have given you the growth rate. Growth rate has been given as per question. Growth rate of the own company dividend is 11%. Right? So using this growth rate, we will calculate the cost of equity. So cost of equity is equal to the dividend, which is 21.4 cents multiplied by 1.11 divided by the market price of the share. So the market price of the share as per question is 321 cents. 321 cents, which is given. The plug-in figures are as follows: 3.21 cents. This is the dividend, and this is the growth rate. So now you get the cost of equity, which is 0.184 or 18.4%. This is using the capital, using the dividend growth model. Right? Now let's calculate the cost of equity using CAPM. So if we use CAPM, the details are as follows. Yes, it's plus growth as well. Obviously, after taking growth, I have arrived at 0.184. Okay, so using the capital asset pricing model, let's look at the plug-in figures first. The plug-in figures are, the beta is own company beta. This is 1.4, and then the risk-free rate. This is the risk-free rate. The treasury bills are usually risk-free. So risk-free rate is 12%, and the market return is also given in the question, which is 16%. That's the market return. 16% in blue. So in blue, you can look at the plug-in figures of the capital asset pricing model. So first we are calculating the cost of equity, then we'll calculate the cost of debt, and then we'll be calculating the WACC. So the plug-in figures over here, 12% plus the beta, which is 1.4. The return on market is 16 minus the risk-free rate, which is 12%. So this gives you the cost of equity using the CAPM, which is 17.6%. So the both won't be same, as I've told you earlier, that CAPM is superior, and then there can be problems in dividend growth model, right? So superiority of CAPM has been discussed earlier. So now we get the cost of equity using both 18.4 and 17.6. Now we need to know the cost of debt. So the cost of debt is also given in the question, but it is before tax. We have to use the after tax cost of debt. So you will be seeing the cost of debt before tax in red color in a minute. Let me select the pen first. So the cost of debt as per question before tax is 12%. So as per question, they say that the debt is risk free. So what do the questions say? I'll highlight in red. Debt may be assumed to be risk free. So as the debt is assumed to be risk free, we can safely take the treasury bills rate 12% as the cost of debt. Otherwise, we have to calculate the IRR, internal rate of return. So cost of debt is 12% into 1 minus T. So the tax rate is 35% in this question. 0.35 will be deducted from 1, and this gives you the cost of debt, which is 7.8%. So that is our cost of debt. So three colors I've used. In red, you can see the cost of equity using the dividend growth model. In blue, you can see cost of equity using CAPM, and cost of debt is in green, 7.8, right? Now let's calculate the WACC. Obviously, the WACC using dividend growth model will be higher. Because the cost of equity using DGM is higher. Okay, so let's calculate the WACC. So it's 18.4 multiplied by the value of the equity. So the rate is 1:2. Debt is 1 and equity is 2. So 2 divided by 3 is equity. And then the cost of debt is 7.8 multiplied by 1 divided by 3. So this gives the WACC, which is 14.87%. So WACC using the dividend growth model is 14.87, and then WACC using the CAPM, capital asset pricing model. So using the capital asset pricing model, 17.6% is the cost of equity multiplied by 2 divided by 3, and then cost of debt is 7.8 multiplied by 1 divided by 3. So this gives you the WACC, which is 14.33%. So this is lower than that using the dividend growth model, as I told you earlier. Okay, so that's cost WACC using cost of equity using dividend growth model and CAPM. Okay, now part B. Usually the DGM and CAPM should give the same values, but sometimes due to the inaccurate imperfect market prices and growth rates problems may result in difference of answer. So that's the answer to under what circumstances would these models be expected to produce similar values for weighted average cost of capital. So usually it should produce similar values. Otherwise, if there are problems in plug-in figures, then there will be difference. So you have to discuss the plug-in figures problem over there. Okay, now part B is again important. The project specific cost of equity to be calculated in part B. So please go through the question, the part B. Please read the part B. I'll be solving the same risk adjusted cost of equity as I did in card company. So this was very important. That's why I've taken 2 questions on it. Sophia, personal tax is just to understand the Modiglianian mirror theory. Tax rate is implemented 12% because we always take the effect of tax shield when calculating cost of debt. So they have given you the interest rate on the treasury bill. So if a loan note is issued, the interest you will be paying will be 12%, but you will be able to deduct that interest from the taxable income and save 35% tax. So the net cost will not be 12%, it will be 7.8%. Okay, Raj? How would I know that RM treasury bill will be used as for RM? No, I've used RF. Treasury bill is used as RF, risk-free rate. Treasury bill is a government security. So if government borrows funds, they issue treasury bill. So treasury bill is risk-free. That's why treasury bill is always a risk-free investment. That's why I'm using the 12% as risk-free rate. No, I've used it for risk-free rate. And treasury bill rate has been used for cost of debt. Why have I used it? Because the question says, the question said that the debt is risk-free. the debt was risk free. So if the debt is risk free, right, so all debt instruments will attract the same rate. So there, that's why I have taken the same rate. Okay. Okay, students, let's move ahead. Now let's calculate this part B. So for the part B calculation, first I will use the formula for de-gearing the proxy beta, proxy company's beta. So I'm picking up the same working first, which I did in the card company case. Okay, first let's de-gear the beta, remove the financial effect of financial risk. Okay. So the proxy company beta is 1.5 in some other industry, which is new for us. Now the equity value is 3 as per the gearing ratio. Then the denominator is equity plus the debt, which is 1, and 0.65, 1 minus tax rate. So if you solve this, you will arrive at the beta asset. So the beta asset is 1.23 in this case. Check, it is lower than the beta equity of the proxy company. 1.23 is lower than 1.5, right? Always it should be lower. Now placing this beta asset means ungeared beta without financial risk, 1.23 into the beta equity formula. So now what's the debt to equity ratio of this company? So the debt to equity ratio of this company is given above. Let me highlight. It's there in the first line. 1.2, the company's gearing level. So it has been given that financial risk is different. So now putting in this formula for re-gearing the beta asset, okay, so the value of equity is 2 plus 1 into 0.65 divided by 2. So this gives you the equity beta of 1.64. This will always be higher than the ungeared beta because this company is more geared. So after including financial risk, the beta will increase, right? So now we can calculate the cost of equity. So let's calculate the cost of equity, which is the risk-free rate was 12% plus 1.64, which is the beta equity, multiplied by the risk premium, which is 16 minus 12. So this gives you 18.56%. So that's the risk adjusted cost of equity. (18.56%). Right. So that's the end of cost of capital chapter. So we have discussed a lot of things over here in the cost of capital. Now we'll start with the business valuation. These two questions, these TFR and Arvin, I'll be doing with the working capital management, right? Tomorrow, inshallah. So now we are moving on to the business valuation chapter. So let's start with business valuation. So let me take some questions if they have been asked. Tax rate is given 35%. It has been given above. Check. For you to check, I'm scrolling up. It's there. In the second last line, the company pays tax at 35%. 0.65 is 1 minus 35%. 1 minus 0.35. Is it clear, Memuna? Okay. K in DGM, DGM stands for dividend growth model. So we have used the same formula, dividend now into 1 plus growth rate divided by cost of divided by the market price plus growth rate. Is it okay, Eddington? The same formula for the dividend growth model has been used. Okay, Rohit, you have problem in beta asset and beta equity formula. There is one formula using which we remove the financial risk of the proxy company, right? Because the proxy company will be having a different financial risk due to having its own capital structure of loan and equity. Our capital structure will be different. We just need to know their business risk only. So first we remove that financial risk, and then we adjusted our own financial risk into that beta. So that was the formula for the re-gearing. Re-gearing means putting in our own effect. Okay. How to equity? They have given it. Sheikh, sorry, Iraj, they have given how to equity. Read the first line of the paragraph appearing on the board. Okay, let me mark. It's there. There it is. The company's own gearing level. It can have the same capital structure. So in that case, we don't have to de-gear and re-gear. Okay, Aisha? But if the capital structure is different, usually in the question, obviously they are going to ask a different capital structure, so that you have to do some working, no? Yes, you can do all calculation in one cell. Doesn't matter. You can do all calculation in one cell. The examiner is bound to check each and every cell of your worksheet. Okay, Brian? Each and every cell of your worksheet will be checked. You can do all workings which are possible in the same cell. Doesn't matter. He's bound to check it. Okay, Sophia, you asked that why did we prefer market value weighted checks? See, suppose that you issue shares and the loan same time, loan instrument same time, and the book values of both are 50-50, right? So when calculating WACC, 50% of the cost of equity will come and 50% of debt will appear in the WACC, right? But now what happens? The value of debt will not change much, but the equity will change very fast. The share prices goes up and the share prices goes double. So after 1 year, if you use the balance sheet, in the balance sheet, they will be appearing again 50-50%. But in the market where people are buying the equity, they will be buying for a higher rate. So what happens that the equity's value become 2 and the debt remains 1. So the ratio changes over there. Is it okay? Sophia, is it clear? So the effect of, we have to take proper weights. If we take improper weights, the cost of equity's effect will be reduced, and obviously the WACC will go wrong, and then NPVs will come wrong. Okay, you need to Eddington, you need to see the working of DGM. Okay, I'll show you. Okay. So working of DGM is on the board now. There it is in yellow. I'm shading it in yellow. Okay. Okay, students, let's move ahead. I almost answered all the questions now. Okay, let's move on to the business valuation now. Let me teach you some basic, some main important concepts of a business valuation today, and then we'll continue tomorrow with working capital management. So let's move on to the next screen, the next handout. Okay, students, let me spell out first the main methods that are used to calculate the business values, right? Let me explain you the background of this topic first. See, what we are going to do over here in this chapter of business valuation is that what do we mean by a business value? So by business value, we are learning to calculate value of a share. Suppose you want to buy share of an oil company, suppose ABC oil company. So what should be the reasonable price for that oil company which you will be uh, accepting to pay? So we are calculating different ways in which we are going to know the different ways of calculating the market price of different companies. Plus, there are marketable securities. What do we mean by marketable securities? Which are being sold in the stock market or in some market where active buyers and sellers are available. So we are going to calculate prices for those securities, marketable securities. One of them is ordinary shares. The other one can be convertible bonds being traded in the market, loan notes being traded in the market, preference shares being traded in the market. So these are the items, the marketable securities, the preference shares, the convertible bonds, the loan notes, the ordinary shares. So we are going to learn how we are going to calculate the market prices or the values of these bonds, right? In this chapter now. So for starting with the shares, ordinary shares, we are going to learn prices of the ordinary shares first. So let's uh, students please read through the closed company. So students, I am giving you a 2 minute time to read the question first. So we have to calculate the market value of the ordinary shares of closed company using these three methods. The value of the company using these three methods: net assets value method, dividend growth model, and the earnings yield method. Dividend growth model can be used to calculate both the cost of equity and the market price. If you remember, there is a market price in the denominator of the dividend growth model formula which we used in cost of equity. So if we shuffle it and remove cost of equity from the numerator and bring price over there in the numerator on the left hand side, so we'll be able to find the price of the shares rather than the cost of equity. The same formula can be used to calculate the market price of a share, and the same formula can be used to calculate the cost of equity as well. So if you are getting a question for cost of capital, you will be using the formula for cost of equity, the same dividend growth model. And if you are if the question the examiner asks you the price, then also you can use the dividend growth model formula. But in this case, you'll be calculating the market price. You'll shuffle the price element to the left hand side. Okay, so students, let's start with this question. The question is asking the value of closed company using net assets value method. So the net assets value method means what are the net assets as per balance sheet? Use them. So net assets, these are the net assets, 490. Net assets means assets minus all liabilities. So asset is 720. Deduct the liabilities from it. So you have 160 million liabilities non-current and 70 million current liabilities. Deduct from it, you will get the net assets from the balance sheet. So value of closed company, first using net assets value method. So net assets value method means assets minus all liabilities. One of the question we will do ahead will involve fair value of the assets. Right now we are using the book value of the assets. So 720 is the total asset position, and we will deduct all liabilities, which is the non-current liabilities are 160 and the current liabilities are 70. Deduct both of them to arrive at the net assets value, which makes 490. So that's the net asset value method. The next method is which they have asked you is using the dividend growth model. I will tell you the concept of dividend growth model as well, that what do the formula show, the dividend growth model formula show afterwards. Let me calculate first in this phase. The dividend growth model to calculate the price will be as follows. I am shuffling the variables which were used to calculate the cost of equity, and this will now become the dividend now 1 plus growth rate divided by cost of equity minus growth rate. So this becomes the formula for the price from the same formula we were using earlier. So plug in the figures over here. So what happens that in this case 40 cents is the dividend as per question. 40 cents has been calculated as follows. Look, they've given you the dividends 40 million, right? And the ordinary shares are 1 million. $1 share, and there are 80 million shares. Right? So I've taken this 40 million over here to calculate the market value of the whole company. You can take share price dividend per share as well, and then you have to multiply it again by the number of shares in order to calculate the full market value of the company. So I've taken the whole of the dividend for the year in this, and the growth rate is 4% as per question. They have given you the growth rate as well. You can see the growth rate over here. That's the growth rate, 4% per year. So 1 minus 1.04, and then divide by the cost of equity. So cost of equity in this question is 10%, minus. So if you note, cost of equity has been given. In the questions we were doing earlier, cost of equity was to be found. So the market price now becomes 693 cents. This is using the dividend growth model. 693 million, sorry. This is the market value. 40 million was the dividend paid by the whole company. 4% was the growth rate, and the cost of equity is 10%, which is given in the question. There it is. Cost of equity is, closed company's cost of equity was 10%. This has been used. So it was simple. Okay, the next part is, the next formula was earnings yield method. Earnings yield method formula is net profit divided by earnings yield. Earnings yield is earnings per share divided by market price. We can take it like this also, or EPS, earnings per share, divided by earning yield. If you use EPS divided by earnings yield, you will get the share price per share. And if you use net profit divided by earnings yield, you will find the value of the whole company, of all the shares of the company. So over here, we need to know the price of the whole company. So we'll use the earnings. So earnings given here is 66.66 in this question. Earnings, there's a net profit, right? So as per the question, the net profit is 66.6. And the earnings yield has been given as per question. Earnings yield of 11% per year can be used for valuation purposes. So using this data, we will calculate the market value. So 66.6 divided by 0.11. This gives you the market value. Of the company, which becomes 605 million. Okay, so three methods we have used. One method says the market value is 490 million. The other one says the market value is 693 million, and the third one says the market value is 605 million. So these are the three formulas which we have used in closed company. Now moving on to the next part. Calculate the weighted average after tax cost of capital of closed company using market values where appropriate. So we will calculate the weighted average cost of capital of closed company. So WACC is required. So let's calculate WACC again. Weighted average cost of capital. So I'm giving you the working over here because we have now been used to of calculating the weighted average cost of capital. So I'm giving you the working directly, the working of the weighted average cost of capital. So that's the working for the weighted average cost of capital on your screen, which is 8.97%. So what I do over here, let me explain you the working directly. First, I calculated the market value of equity. Market value of equity is 80 million shares into $8.5, which is the market price given over here, 8.5. Gives you the 680 million market value, then the value of the bond, bank loan, and the value of the bonds. So the bonds were 120 divided by 100 gives you the number of bonds, and one bond is of 104.77. So 104.77 is the market price of one bond. Which makes 126 million. And the bank loan is of 40 million, and the bank loan's face value and the market value both will be same. So you won't have to calculate the market value because bank loan are not saleable in the market. It is not a marketable security. That's why we take it as it is. The 40 million is taken as it is. Okay, now there's a question. From where did I get this 104.77? Students, now listen carefully. From where did I get this 104.77? The value of the bond. This I have to calculate now. This I have calculated with a formula. Now, the important concept is, students, please listen carefully now. There is an important concept that how do we calculate value of various investments? So the concept is that what do you expect from an investment? You expect to receive some benefit or cash from the investment. So what you do, that when you are purchasing an investment, you first calculate that what cash inflow will occur in the future. So first you make a budget of what cash flow will occur in the future, and you calculate present value of that cash flows. Now, suppose that if you invest in a share, you will receive dividends. So you will calculate present value of those dividends, like in dividend growth model. What does dividend growth model do? It calculates present value of all the dividends which are expected in the future, considering its growth rate. So dividend growth model is nothing else. It is just present value of the dividends which will be paid to the investor if he buy the shares. So value of an investment is basically present value of the future cash receipts due to making that investment. So if you purchase a loan note, what do you expect to receive? If you purchase a loan note, you expect to receive interest, and when the loan note will be redeemed, at that time you expect to receive the repayment. So the value of a bond or the debt instrument should be equal to the present value of the interest and the bond and the bond's repayment. That's the value of the bond. So in that way, I have calculated this 104.77 million, the value of the bond. So let me show you how I have calculated 104.77. I've just calculated the present value. So if no method has been given for valuation of a share or loan note, you can simply calculate the present value of the future cash flows expected from that bond. No one will pay more than the present value, because the benefit you get today in terms of present value, you won't pay more than that. If you pay more than that, your wealth will decrease. So obviously you will pay at most how much? The present value of the inflows associated with that investment. So let's calculate the present value of the interest and the repayment amount from this bond to arrive at the market value. So now I will showing you the value of this bond, how to calculate the value of this bond. So this is how I have calculated the value of the bond. The face value of the bond was 100 million. First I took the cash flow. So the cash flow involves the interest and repayment of the bond. So the interest involved in the bond is 8%, which is 8% into 100, which is the face value, and the redemption amount is 100. Then the time, 8 million will be received from year 1 till 6. And then the redemption will take place after 6 years. The life of the bond is 6 years. Now calculate the present value of the interest. Take a present value fraction. Now what present value fraction will you take? Present value will be taken at the cost of debt. So the cost of debt is given, which is 7%. 7% is the cost of debt as per question. So take an annuity fraction at 7% for 6 years. So 4.767 is the annuity fraction. And then the present value fraction is 0.666. So there you get the present value. This present value become 8 multiplied by 4.764 and 100 multiplied by 0.666. This gives you the value of the bond, 104.7. This is how I got. So 38.13 if I round it off to 2 places, and 66.63. So this gives you 104.76. So this was the value of the bond. Okay, did you get it? So it's simple. How will you calculate the value of a bond? So if suppose a company issues a loan note, a bond in the market, so its value is the present value of all the interest over its life and the repayment amount's present value at the cost of debt. The cost of debt was given in the question. It's there. Cost of debt 7%. So if you use the rate cost of debt, then you don't need to deduct interest from the tax from the tax from the interest working. No, if nothing has been mentioned, the bond will be redeemed at par. But if the bond is redeemed at premium, they will tell you that bond is redeemable at 10% premium likewise. Yeah. See, if you are given before tax cost of debt and you use it, so then no need to deduct tax from the interest. So you will get the same answer, right? After tax cost of capital means after tax cost of capital means see over here we are not calculating cost of capital. We are calculating cost of debt. Cost of debt is entirely different. Cost of capital means WACC. Now after calculating this cost of debt, we will calculate after calculating this market value, we will calculate the WACC from it. In this step, we have just calculated the market value of the bond. So as I have taken the interest gross, I can take uh, the cost of debt also gross without deducting tax from it, right? But if you take the interest net of the tax, 70% you take the interest, then you can net off the cost of debt as well. Like you can take 70% of 7%, 4.9%. It will give you the same answer. You can check it afterwards, right? So Sohail, please do check afterwards, after the class. And same answer to Aisha as well, right? Okay. So now uh, this is how I got 104.77, and now after that the cost of equity is 10%, cost of debt now. Over here we are calculating WACC. WACC is always after tax, so you can't use before tax rate over here. Always you have to take after tax rate. WACC is after tax, right? So over here I have taken 70%, means the effect of tax shield has been taken over here. In both cases, we have taken the effect of tax shield. Okay, so now calculating the WACC, I have placed 10% cost of equity, 4.9% after tax cost of debt, and 4.2% after tax cost of bank loan, and then the market values from there: 680, 126, and 40 million, and divide by the totals, 846. There you go. You arrive at the 8.97 WACC. So that's the answer to our question. Close company, weighted average cost of capital. So in this case, in order to calculate the weighted average cost of capital, you needed the market value of the 8% bond, and you arrived at the market value by calculating the present value of the interest and the repayment amount. Okay. So you can take 8% with tax. You can take 8% with tax, 8 into 0.7. Then in that case, you will be using the present value at 4.9%. Etc. If you take interest net of tax over here, then take 4.9% over there when calculating the present value. Don't use 7% then. But usually what we do, it's 9%. 9% is perfect. This is approximately 8.97. 9% is perfect. WACC is approximately 9%. This is some rounding of difference only, Ibrahim. Okay, so see what you do. First of all, calculate the market value using the before tax figures of the bond, right? And then when calculating WACC, calculate the cost of debt net of tax. This is usually a practice which we use, right? So otherwise you can net off both things, the cost of debt to discount it, and the interest as well. Both of them can be discounted. Okay, so let's move further now. So the next question now, moving on to the next question, is a GWWW company. GWW company. Question number 2. So let's start with GWW company. Please read the question, students. Now let me first read the requirements of this question. What do this ask for? Now this is an important question. It asks for market capitalization. What is market capitalization? Market capitalization is the market price of the share of a company multiplied by the number of shares issued by the company. So its market capitalization means the value of the whole company. Price of one share multiplied by the number of shares. Then net asset value, then price earning ratio method, and then dividend growth model. And dividend growth model using historic dividend growth rate and Gordon's model. So this is how we are going to calculate the value of GWW company. These 4 methods in here: market capitalization, net asset value, price earning ratio, and dividend growth model. So students, please read the question first, then I'll solve it. I'll be starting in 2 to 3 minutes time solving this question. Okay, students, I'm starting doing this question now. First of all, the market capitalization. So the market capitalization is equal to market price of the share, the stock market price, multiply by the number of shares outstanding. So the market price of this share is $4. So $4 is the market price, and we need to multiply it by the number of shares. So the number of shares outstanding are 40 million shares. So it's 40 into 4, 160 million. So how did I get the number of shares? So number of shares has been calculated as follows. There were 20 million ordinary shares as per question. 20 million ordinary shares. And the face value of each share is 50 cents. So what I do is I will divide 20 by 0.5 in order to get the number of shares. So 20 divided by 0.5, I get the 40 million shares. So this is how I got the market capitalization. So this was the first part of this question, the market capitalization, which is 160. 160 million is the market capitalization, means the stock market price multiplied by the shares outstanding in the stock market. It gives you the value of the whole company. So you get the market value of the whole company. Next is the next requirement is net asset value method. So as I said earlier, the net assets value is assets minus all liabilities. So let's calculate the net assets value. First we will take the assets, book value of the assets. So according to the question, the book value of the assets are 91 plus 8.3. This gives you 91 plus 8.3, 99.3, and then book value of liabilities. Now what do we mean by liquidation basis? They've asked you liquidation basis. What do we mean by liquidation basis? By liquidation basis we mean that if the company dissolves immediately, what will be the market value at that time? So if the company dissolved immediately, what will the market value of assets and liabilities immediately, right now? So the first of all, we are taking the book values from the balance sheet date, and then we'll convert it into the market value. So the liabilities are 7.1 plus 25. And this gives you the book value of the equity, assets minus all liabilities. So if you deduct assets, if you deduct all the liabilities from the assets, you get the net assets. But this is the balance sheet value. But we need the liquidation value method. Liquidation value means the fair value at the time of dissolution. If you dissolve it right now, what will be the market values? So what the question says now over here, you can see from the question. Please go through this paragraph over here. Okay, let me first erase the drawings, then we move on to the values. Look, they say that the expected net reservable value of the non-current assets and the inventory are this much. Inventories NRV is 86 and the non-current assets is 4.2 million. If you look above, the non-current assets are 91 and its NRV is 86, means the value has declined by 5 million. And if you look at this, inventory 3.8 appear in the books and the market value is 4.2. So inventory needs to be increased by 0.4 million and assets, non-current assets, to be decreased by 5 million. So let's do it now. Let's make the fair value adjustments. These are known as fair value adjustment. The first adjustment is non-current asset value lower by -5. Then inventory value higher by 0.4. And then receivables. About receivable, they say that only 80% are collectible. So 20% needs to be written down. So the receivables are 4.5 multiplied by 20%, which needs to be written down. So now this gives you the market value on liquidation basis, the fair value liquidation basis. The book value plus the fair value adjustments gives you 61.7. That's the answer to the net assets value method. So two methods gone. Market capitalization done, then the net asset value method done, and then it is the price earning ratio method. Next one is price earning ratio method. So let's calculate the price earning ratio method. P for price and E for earnings. So PE ratio method, price earning ratio method. So by price earning ratio method, you can find price is equal to market price of the share is equal to earnings per share, EPS, multiplied by the price earning ratio. So as per question, first you need to know the earnings per share. What is the EPS? The latest EPS is 10.1. Given over here, the latest EPS is 10.1. Then we need to know the price earning ratio. So in order to know the price earning ratio, if you read the second line in the paragraph, which I have underlined in red, average price earning ratio of the business sector is 17 times. So always use the average or the price earning ratio of a similar company in order to calculate the market price. So the EPS was 10.1 multiplied by 17. So this gives you the market price. So this is the price of one share, 171.7. Now if you want to know the market capitalization, so this is 171.7. 10.1 was the net profit. What I've used to calculate the, if you multiplied the EPS by price earning ratio, you will get price of one share. But instead of Using EPS, I have used net profit so that I get the market value of the whole company together. So in this case, I have done it directly. I've got the market value together of the whole company. Okay, so moving on ahead now. To the next method of the question. This is dividend growth model using historic growth rate. So let's do with dividend growth model. Dividend growth model using the historic growth rate. So let me first pick the formula of the dividend growth model from the previous question. The formula for the dividend growth model is D1 plus growth rate, cost of equity minus growth rate. Now see how I get the growth rate first. Now the plug-in values. Let's look at the plug-in values first. So let me find the growth rate using the historic average growth rate. Use the dividends to calculate it. So the latest dividend is 6 cents, 6 million, and the earliest dividend was 5 to the power 1 upon n. So in how much time did this happen? In how much time the dividend increased from 5 to 6? It happened in 3 years time. So this gives you the growth rate, which is equals to 0.0627. This is the historic growth rate. And then the price will be equal to the latest dividend, which is 1.0627 divided by 0.09, which is the cost of equity. 9% is the cost of equity given in the question. There is the cost of equity, 9% per year. Minus 0.0627, the growth rate. So this gives you the market value of the company, which is 233.56. This is using the historic growth rate. Now the Gordon's model. Growth rate equals to RB. Using the Gordon's model, growth rate equals to RB. Now what is RB? R stands for average earnings retention. Retention means after payment of dividend, the profit that remains back. This is R. And then B is, uh, sorry, B is retention rate, and R is the rate of return. Latest rate of return on investments. That's R. So now, according to the question, what is the average earnings retention? So we have to first calculate the average earnings retention from history. So in order to obtain, what do we mean by retention? By retention, we mean the profit after payment of dividends, the profit left behind after payment of dividend. From the question, what we will do, in order to calculate the average, we will take all the earnings. You will add all of these earnings. Add these, and from this, the sum of these, you will have to deduct these dividends. So from sum of the profits after tax, if you deduct the dividends, this gives you the average retention rate, average percentage of retentions. So let me calculate average retentions first. So for average retentions, 8.5 was the first dividend, then 8.9, then 9.7, then 10.1. And from this deduct the dividends. So the dividends are minus 5, minus 5.2 million, minus 5.6 million, and minus 6 million. Now this should be divided by the average profits. Divide this by average profits. Retention rate means percentage of retention, percentage of profit retained. Like if you earn 100 rupees profit and you pay 40 out of it, so 60% is the retention. So how did you get 60 divided by 100 gives you 60%. So the retained profits divided by the total profits earned. So we'll divide by the total profits earned, which is 8.5 plus 8.9 plus 9.7 and 10.1. So this gives you 41.4. So the formula is total of retentions divided by total of profits in past. This was the formula being used. Is 41.4%. Okay. So now the latest, what's the latest return on investments? So latest return on investment will be calculated as follows. The latest return on investment is net profit divided by the net assets. This is the formula. So net profit is the latest, take the latest net profit. Retention is average, and the net profit is, it is not average, it is actual. It is the latest. The latest net profit was 10.1 divided by the net asset 67.2 from the balance sheet. So how did I get the 67.2? So all the assets minus all liabilities will give you the net assets. So this makes 10.1 divided by 67.2 multiplied by 100, 15%. So it's 15.03%. So now the growth rate is equals to, according to the Gordon's model, the growth rate is equal to R multiplied by B, 0.414 multiplied by the B, 0.15 into 100. So this gives you 6.21% is the growth rate. So now if you plug in to the formula for the dividend growth model, so put in the dividend growth model formula, the latest dividend was 6 multiplied by 1.0621 divided by the cost of equity 0.09 minus 0.0621. So this gives you the market price using the dividend growth, the growth rate using the Gordon's formula. So 223 point. So solve this. If you solve this out, you'll get the market price, which is 228.4. So 228.4 million is the market price using the dividend growth model. And the last part of this dividend growth model using Gordon's model. So students, let's do the last part of this question, and then we'll continue in the next class. or I would say that let's continue in the next class only. You can uh, uh, I feel that we should end our today's sessions over here, because a lot of parts are left. So we'll do it tomorrow, uh, so that we will be fresh at that time to calculate the market value of bonds as well. So you can just copy this out, the dividend growth rate using the Gordon's model, and then we will continue in the next class. So I hope that concepts up to now are clear. Okay, students, thank you very much for attending the session. Day 3, it will continue now tomorrow. And tomorrow's topic are a bit of, we will do a bit of business valuation further tomorrow for the first hour, and then we'll move on to the working capital management. So see you tomorrow. Good night. All the best. See you tomorrow. Allah Hafiz.